Hey there, savvy investors, and welcome back to FX Limit. Today, we're diving into the intricate world of fundamental analysis to uncover how global economic trends can swing currency values. So, grab your notepads, because this is where the real magic of currency trading begins. Let's start with the basics. Fundamental analysis is the cornerstone of understanding the intrinsic value of currencies. It's the process of looking beyond the charts, digging into economic indicators, and getting a pulse on the political climate to predict market movements. Remember, in the realm of Forex, knowledge isn't just power, it's profit. Now, imagine the global economy as a complex engine, and the currencies are the gears that keep it running. When one gear speeds up, slows down, or gets stuck, it impacts the whole machine. That's exactly how global economic trends influence currency values. Consider interest rates, for example. They're like the financial world's heartbeat. Central banks adjust these rates to either encourage borrowing and spending or to put the brakes on inflation. A hike in interest rates usually means the currency gets a boost, as higher returns attract investors. On the flip side, a cut in rates can send the currency value down since investors might start looking elsewhere for better yields. But it's not just about the rates themselves. It's the expectation game that truly moves markets. If traders anticipate a rate change, they'll act in advance, and you'll see currency values shift even before the actual decision. As a fundamental analyst, your job is to be ahead of the curve, to gauge market sentiment, and to be the first to catch those subtle hints that a change is coming. Inflation is another big player. It's the silent currency killer that can erode the value of money over time. Countries with low and stable inflation rates tend to see an appreciation in their currency value, while those with high inflation may find their currency losing its luster. Now, let's not forget about gross domestic product, or GDP. This is the grand sum of all goods and services produced, and it's a snapshot of economic health. A booming GDP often translates to a strong currency because it suggests that the country's economy is in good shape, attracting investment from all over the world. Political stability, or the lack of it, can also send shockwaves through currency markets. Investors love predictability, and when political turmoil hits, they often flee to safe haven currencies that offer stability, like the Swiss franc or the US dollar. So how do you keep a finger on the pulse of all these factors? It's simple. Stay informed. Keep an eye on economic calendars for upcoming announcements and reports. Follow the news to catch any political developments, and always analyze how different scenarios could play out in the markets. Remember, currencies are sensitive creatures. They react to the slightest changes in economic forecasts, geopolitical tensions, and even rumors. As a trader, using fundamental analysis means you're a bit of a detective, piecing together clues from various sources to predict where the market will head next. Lastly, don't get too caught up in the short-term noise. Fundamental analysis is about understanding the long game. It's about making educated guesses on a currency's future value based on solid economic principles. So, take your time, analyze the data, and trust in the fundamentals. And that's a wrap for today's session at FX Limit. You now have the blueprint to decode global economic trends and make them work for you in the currency market. Remember, the market speaks in numbers and events, and with fundamental analysis, you've got the key to crack the code. Thanks for tuning in, and until next time, keep analyzing and keep profiting.